Hello, ladies and gentlemen. Thank you so much for tuning in to the SHC Division of Business podcast. This is your host, Ethan Sisk, and today we'll be featuring Andrew Grinstead. In today's episode, we'll be covering the value of diversification in portfolio management, Grinstead's rise to becoming CEO, and how he feels people can invest in themselves. Hello, Mr. Grinstead. Thanks for coming on.
Yeah, thanks for having me, Ethan.
Yes, sir. To start, can you tell us a little bit about your background
Sure.
and backstory for the audience?
Yeah, so we've been in Mobile for about 20 years,
With Leavell Investments?
Yes.
Or your family?
Yes. Well, my family has. So I moved to Mobile about 20 years ago.
Yes.
But currently working for Leavell Investments, which is a wealth management firm based here in Mobile. I'm the CEO. We also have an office in Birmingham. We manage about $2.4 billion, mostly for individuals and families. And my background is, been in finance my whole career. So I started off in investment banking, worked in private equity, worked for a family office, and then also worked for a hedge fund. So, that's kind of my background in the field.
Wow. Pretty diverse background.
Well, and I also taught here for a little bit as an adjunct. I taught Finance 401, and I really enjoyed that.
I wish I could have been here in that time frame to do this every day.
Yeah, sure. Well, I think the great teachers here, and I love the way they get to, get to know the students personally. That's a really valuable thing about being here.
It's a good aspect of a small school. And
and I still have some students who have stayed in touch with me, and a few that reach out from time to time. And some of y'all are going to end up in our field and our career. So happy to be here to talk about all this with y'all.
Definitely.
Yeah.
So you've got 4 kids?
Yes.
And they were all raised here in Mobile?
They were. They were all raised here in Mobile, and I've got. Then they all went through McGill-Tulane, and I've got one's still at McGill, so he's a freshman.
Oh.
Yeah. So.
And then where were you raised?
So I was raised all over. So I was born in Montgomery, but my family, is from Greenville, Alabama, which is halfway between Mobile and Birmingham, and my grandfather on my dad's side was in the Navy, so my dad had lived all over because of that, and then he was in the Navy for a little bit, so he was used to moving, and I think my mom wanted to see the world, so I think we lived 12 different places before I went to college.
Wow.
So we moved around a lot, but always came back to Alabama for family vacations and holidays and stuff like that. So when people asked where were you from, I would always say Alabama, and then they would tell me, well, you don't sound like that, but yeah, Alabama's always been in my mind, at least home.
Is it Alabama or Auburn? Come on, which one?
Yeah, Roll Tide. So
okay,
yep,
gotcha. Where'd you go to college?
So I went to Harvard undergrad, and then I ended up going to Kellogg for business school. So
nice.
Yeah,
nice.
And I was an economics major at Harvard.
Does Leavell manage employees' investments, or is it strictly individual investors?
Sure. So it's both individuals, families, some corporate money as well, some nonprofits. So it's mostly folks from the community. So it's very relationship based. So we have clients that are, probably in 20, 30 states, and a couple of international clients. But our core client is 1 degree of separation from us. Mm-hmm. So it's folks that we kind of know personally.
Nice.
Yeah.
So with your position being the CEO, which of those groups do you target most to invest for?
Yeah, so I think really families and individuals. And so we have sort of 3 roles within the firm. We have portfolio management, which is folks that actually, a lot of them have CFAs and that kind of background. And they're the ones who are deciding what securities go in portfolios. So what we're going to buy for our clients. Then we have investment counselors, and they're really like a certified financial planner or CFP type. And they go out and really interface directly with the clients. And then we have an operations team that does all the back office processing that needs to happen in terms of trading and executing on what our plans are. Initially, I worked managing just the investment committee. And so we're asset allocators at heart. What happens on a day-to-day basis in the market is not as critical to us as it might be to another type of strategy or whatever. And so it's really, long-term ideas. And so that's what we do in investment, committee. So I did that at first. And it was when Tom kind of approached me and said, can you help us look at, what comes after me? And so that's when I got more involved and helped sort of lead that buyout.
Gotcha. What would you say the pros and cons are of trying to outperform the market versus just putting your money in an index fund?
Sure. So, I mean, I think, there's, this topic of, what I would call alpha and beta, and beta being, market performance, and alpha being, that outperformance. And I think alpha is extremely difficult and challenging to come by.
And for the audience, beta is long term and alpha is short term?
No, so it's really comes more from relatively I guess famous equation, and what it is that the return on an asset is equal to alpha plus a stock's beta or a security's beta. So it's covariance with the market times the market plus some error term or whatever. But what that's been reduced to in nomenclature is beta being, what you get if you buy all the stocks that are out there, and alpha being what you get if you bet on just one stock or a small group of stocks. And so it's really this tension between having exposure broadly to this idea of human innovation, of coming up with new ideas to solve problems, but not necessarily saying, I know where that's going to come from, what the source of that innovation is going to be. And so you can imagine, like, you think about sort of auto dealerships, auto companies, there are a lot of auto companies out there. They're all hired, really smart people. They're all trying to make a better car. And beta is this idea that, like, if I buy all the car companies, I effectively get, some return from them all trying to make a better car. Whereas if I buy one car company, I'm kind of saying, I think that they're going to make the best car. And there's a tension there in terms of, which one's going to be right. With beta, you're really betting on human innovation broadly. With alpha, you're betting on, a specific outcome.
How confident are you in the consistency of human innovation?
I think fairly confident. I mean, I think, I do think that that's part of the human psyche. I think it's to some degree God-given, this idea of wanting to be creative, sort of mimicking God's creativity. And so we're sort of echoing that, if you will. And so I think that, most people I know, sort of, you could be doing the most sort of mundane project around the house or in the garden or something like that, and or the yard or whatever, and you think, there must be a better way to do this. Mm-hmm. And so even I think sort of intuitively, people know that they're sort of, they want to innovate. If they're doing a routine project, they try and find a way to do it a little bit better. And, that seems to be part of mankind's spirit, if you will.
So advancement's just one of our inherent characteristics.
Yeah, I think so. But I think it comes from creativity. I don't know if it's necessarily advancement, but it's a good sort of philosophical question. I don't know, but it's at least since the Industrial Revolution, it seems to have panned out that way. Will it always? I don't know. I think that's also a relevant question. But certainly in our lifetime, there's been a pretty steady increase in labor productivity. Definitely. Measured by economists, and that doesn't seem to vary as much as you think it would, given all the sort of random new innovations that come out. There seems to be some time frame it takes for those things to be absorbed into making things more productive.
One of the things I did some research on was just like humans' relationship with technology. We're constantly advancing it because we can never be satisfied with the iPhone 10. We got iPhone 12 and in all different technology sectors. Yep. So I heard someone say, like, is it humans' purpose to, like, advance the technology for something else, which brings a different sphere of questions. But
no, and I think it's good. I mean, and there's certainly people who are, I certainly have friends in the financial services space that really focus on that desire for, I think human flourishing, if you will,
Yeah.
and innovation. I sometimes think we get a little further over our skis because there's a lot of overpromise and underdelivered on that front as well. But I do think it's a little bit more constant than we think it is. We usually think it's going faster than it is. But I think innovation keeps you from being, or at least the record of it, keeps you from being pessimistic. I know we talked about earlier about Thomas Malthus and those views that we're going to run out of X, Y, Z. Obviously he's been sort of dramatically wrong. But it's sort of like the I don't know if you ever heard the story of the turkey and the turkey farmer. I mean, the turkey thinks everything's good until he goes out the week before Thanksgiving and gets his head chopped off. So you never know what's around the corner. I think you got to sort of be humble about what the future might hold. But
definitely. In looking at investing and kind of deciding if you should or shouldn't, do you feel like a positive reason could be that humans are, kind of desire to kind of create?
Yeah, for sure. And I think that, and you can just think within your own, again, field of interest or whatever, think about the knowledge base today versus the knowledge base 10 years ago versus the knowledge base 20 years ago or however far back you want to go. There's not a field where people aren't trying to push the knowledge base, and so what happens when you invest in a company is, you own the means of production. And if I, find a creative way to, lower the cost of producing something, and I own that company, then, a lot of the benefit accrues to me. I mean, it accrues to the consumer as well, but, so that's investing in a very broad way is saying, positive exposure to human innovation.
So if investing was just based off of, our known desire to create, it would be a pretty much destined win.
Yeah.
But do you think, what factors negate that and make it not always necessarily a win?
Well, I mean, so...
like inflation or...
Yeah, so there's, again, the market is sort of, again, we're getting kind of broad here, but I mean, when you think about the value of a financial asset today, what you have is a claim on the future cash flows of a company. And then when you think about the market as a whole, you have a claim on the future cash flows of the market as a whole. And those two things are slightly different, but generally speaking, when you're trading off, investments, you're trying to say, what does that future look like? And some of that is speculation, right? Because neither you nor I know what the future looks like. And so
the only predictable thing about the future is that it's unpredictable.
Yeah, well, and that you have a different feeling about it than I do. The market wouldn't exist if we didn't have different views as to the prospects of innovation and where that would lie. And so we're always trading off. And one of the ways I think of it is we're always trading off, the risky asset, the asset that the unknown versus the safe asset, the asset that it protects us the most. And so there's this trade-off that we're making, and we're making it between lots of participants. And there's both sort of a fundamental aspect of what the companies are doing that drives that, but then there's also this sort of speculative aspect of what how different investors feel. And it's sort of like a piece of art that's an intangible thing that's very difficult to sort of say, is this art valuable or not valuable? It's, whatever price people are willing to pay for it.
Why is the individual's preference so valuable in your field?
Yeah, so, I mean, I think there's a couple things. One is that I think, people have these different trade-offs, right? And so, like we talked about maybe earlier, there's this idea, even just in terms of, the trade-off between consumption and saving, how much do I want to spend today? How much do I want to spend tomorrow? And, that's going to vary depending on, where you are in your life, what your views are in terms of what you want to do with your money now versus later, and then all the other factors that come in that are out there in terms of constraints that are placed on you by other forces, and certainly if you're married, your spouse as well, and so you bundle all these things up, and people have different preferences, just like someone wants a blue dress and someone wants a green dress, and part of what we do is sort of help advise folks based on where they're coming from. What legacy do they want to build with their life? And that may be different than, your answer to that question. And so that creates, space for sort of counseling, if you will, and, deciding how much risky asset do you want, how much risk-free asset do you want, and what's the combination of that, and how much consumption today do you want versus the future. And so it's kind of fun because it's a very relational type of business where you've got to sit down and be a good listener and hear what the client's saying, and then sort of translate that into what's available in the marketplace.
How often do you have to break away from, like, let's say I'm wanting to invest in a certain industry, but now that industry is not very profitable. I still want to get to this financial goal.
Yep.
How often do you have to kind of swing your investors' emotions?
All the time. I mean, you're always sort of pivoting to the current market conditions. But I mean, you also have to be truthful. I mean, sometimes people's expectations aren't realistic. And so, we have a saying, you can't get there from here. And so part of it also is just sort of saying, hey, that's wishful thinking, or, that's probably not the way it's going to play out. And so I think sometimes it's, helping people understand what the options are.
Yeah. How do you go about establishing trust with your clients?
No, that's a great question. And I think trust is the key to our business. Our tagline for a long time was Trusted Investment Solutions. And trust is one of those things that, like love or something like that, it takes a long time to build and can be destroyed pretty quickly.
Yeah.
And I think it's really a sort of needs to be a methodical thing in terms of executing on what you say you want to deliver. And so I think even as students or whatever, you can start building trust amongst your peers and whatever by saying, hey, I'm going to meet you here at 5 o'clock. Well, if you meet the person there at 5 o'clock, then that becomes sort of first indicator of trust. And it's a layered thing, so it builds up over time. And for us, I think it's a lot of it's in the community as well, where we have to sort of build up trust that we care about the community, that we're here, and that we're here repetitively. And I think that's the nice thing about running a business like this in Alabama is that there is sort of longevity to people's memory in a place like this. And so, trust takes years to establish, and can only be maintained by continuing to deliver on the things that you've promised people.
I assume you've weighed out, like, moving like if your business operated in a larger market than Mobile, for instance, Dallas, where I'm from, you'd have potential more clientele, but in Mobile, it's that small town, and you get your name travels better.
It does, and although I think and this is something I found that which is in some ways sort of comforting, right? In the age of technology and all that, like makes certain things sterile, but like life is about relationships, and I think you find a lot of meaning in relationships, and I think that that's true whether you're in Mobile or in Dallas or wherever.
Yeah.
I was talking to the first guy I ever worked for in the finance industry. I had a summer internship in investment banking, and I got a chance to visit with him up in Boston not too long ago. And he was telling me a story of a young person who, did something that sort of destroyed trust in the relationship. And I was just really remarkable that that's so important, and even at sort of a junior level, you've got to follow through on the things that you say you're going to do, and if you don't, it poisons the whole well, and people in your organization can't trust you. Extends to clients, et cetera, et cetera. So I still think it's very much a trust-driven world.
Definitely, and humans are social, and
that's right.
That's what.
That's how we are. Yeah.
So in your career, you've done the analytical side, and now you've transitioned to the, I guess, leadership in person, interpersonal side.
Yep.
What are your, takeaways from being in both?
Yeah. I think everyone can find their niche, and I think that that will sort of happen naturally. You don't have to be anxious about it. You're faced with many choices over time, and
is your niche the analytical or the interpersonal?
I think more the interpersonal. I sort of realized at Harvard I had a lot of friends who went on to get PhDs and really go down the rabbit holes of deep expertise in a subject, and I saw what that looked like, and I'm impressed and often in awe of folks that have that expertise, and from time to time jealous. But I also knew that it wasn't really suited with my personality. I liked. I mentioned I was the sort of jack of all trades, master of none. I like the variety. Variety is something I like, and it took me a while to sort of embrace that was actually a skill and that was actually a positive. Because most subjects, there's always somebody else that knows more than I do. And, if you're going to be a generalist and you're going to be sort of you've got to be willing to let that ego part of it go.
What would your advice be to up-and-coming students that haven't necessarily found their niche?
I think, we're faced with choices every day. And again, we make trade-offs every day. And I think part of it's just being deliberate about recognizing what those are. My wife was really good at telling me, the idea that if not saying no is also a choice, and so that you have to sort of be conscious about your time, as we talked about when we were walking over here. Time is our most valuable asset. And, I think it's Psalm 39 says, Lord, remind me every day that my life is fleeting, and I think that memento mori, this sort of idea of like, recognizing the shortness of our time is important. And in doing that, it makes us, I think, focus more on the day and the choices ahead of us. In our company, we don't actually have long-term strategic plans, somewhat to the dismay of some of my partners. But I've always been sort of the view that like excellence today is what you should seek. The sort of joy in the journey type thing, where you're really looking at the choices in front of you today, and not being anxious about the choices that will be 1 year, 5 years, 10 years down the road.
And does that kind of play into making the decisions that'll benefit you in the long term, not the short term?
A little bit. I am kind of a guy that's less about, thinking about choices based on expediency. So I think less about cause and effect. Like I think less on, the ends and more on the means. And so if you think about it from a Kantian ethics kind of point of view, like I think more of it like, the world is complex, and if you don't believe that, go work in the markets for 30 years and try to predict the future.
Yeah.
It's
Good luck.
Yeah, exactly. It's very difficult to do, and even the best people may just be lucky. We're not sure. But you have this sort of in a complex system, these choices of expediency, I think, are really difficult. Instead of saying, I want this end. And I think the world may actually be designed such that, expediency isn't really the way we should look at it. But what we can do is we can look at, is this a just choice? Is this a merciful choice? Is this choice based in goodness? And so rather than looking for the end that you want, look at the ethics of the choice that you're making. I generally espouse that view versus sort of saying, I want this end goal. I think if you want an end goal, you can ultimately. Lenin said, all things are permissible for a man who basically is driving to achieve his goal, and I think that's a very dangerous path to go down because if you have a goal and you're really serious about it, um, ethics goes out the door. Whereas if you lead with ethics, you're kind of humble about what the outcome might be. That's really, I think, in God's court.
Mm-hmm. One thing you mentioned earlier is, in pertaining it back to investing, is that you want to invest in yourself, not someone else, and also not give your money to someone else to invest. Yep. Even though you deal with portfolio management, which is, I feel like, a very humble thing on your end to bestow upon us.
Sure. I think again, going back to that sort of alpha versus beta, and alpha being sort of like the idiosyncratic or the special, bet, if you will. Yeah. Another analogy people always talk about hitting the home run ball, right? Yeah. I mean, it's the investment that you're really trying to outperform with, and I think most of the cases I've seen where those things have paid off in my life have been people that were willing to bet on themselves or a situation close to them where they had special insight. We kind of talked about the gold rush in our talk, and
I think that was great, showing it was a mountain with everyone, a single file line at the top.
Yeah.
And like that is Bitcoin and all the popularized investments.
That's right. And that you've got to think about where you are in that line. And if you're the first one to the gold, that's great. But if you're the 3,000th person to the goal or the 3 millionth person to the gold, you might not be getting a good deal. Mm-hmm. And so I think alpha requires some sort of specialization, some sort of willingness to do something different. And I think your opportunities to do that are you're going to see that opportunity best when it's something in your own sphere, when you are the expert or when you are the one that has the opportunity to buy that asset or invest in that piece of land or whatever it might be.
Gotcha. So in trading, volume of a stock is in variability. Does volume if it's a alpha stock, meaning everyone's buying it, is volume an avid indicator of that?
I don't know. There's 1,000 different ways to skin the cat, and everyone's kind of got their methodology, and I think that there's more than one methodology that works. One of the problems is that most methodologies, if they're successful, again, if you find the gold, tomorrow there's a lot of people around digging in the same hole.
Yeah.
And so whatever strategy you have, you've got to kind of be constantly reinventing that and finding that. And so, at our firm, we don't really look at short-term stuff that much. There's so many people out there that are focused on short-term things, and volume would certainly be an indicator of that. I do think, we do think about breadth, and that breadth meaning like how much is there support for an idea in terms of like, is it coming from one place or is it coming from lots of places? And I think in the broad markets, we think about breadth broadly, like are a lot of stocks going up or just a few stocks going up? And historically, when there's been poor breadth, that is not a good leading indicator of the future.
Do you give credit to ethics for say not dig in a previously dug hole? Because it'll kind of lead you
I don't think that it's as much of an ethics thing as it is just a practical knowledge. Okay. Because some things come back around. And so there's certainly investing ideas that come in fashion and go out of fashion, and then come back in fashion. So there's styles that that come and go. So I think that less of ethics. I think ethics more of really being about how you treat people and treat people around you. We're all, technology tries to let us scale all these things, right? So we can scale, meaning that, like we talked about earlier, that one person can do the work of 65 people from 1750.
Yeah.
and that's great in terms of actually producing goods and services and stuff like that.
A question on that.
Yeah.
Do you think that productivity is negated because nowadays there's a lot larger demand because there's a larger population?
It's there could be, but it hasn't been yet. I mean, so that pace of that innovation, since the Industrial Revolution, so maybe I don't know, 1800s, it doesn't look like it's changed. Now you can certainly see inflection points with global wars and stuff like that.
Yes.
So, but in general, it doesn't. I don't sense that. In fact, I mean, I think. Not that I would agree, but I think a lot of people are arguing that the pace of innovation is going to increase, particularly with AI and stuff like that. And it may. I mean, we may be at an inflection point, but
do you find it could bubble? Because then, if the rate of innovation bubbled, then that's going to downturn the whole entire market significantly.
Yeah. No, I don't. Bubbles are dangerous words. And,
I'm trying to get you to forecast something.
Yeah, I know exactly. No, and I think part of it's more of than sort of giving a specific forecast. And there's a book, I'm trying to think of the name of it. That my brother-in-law is a history professor, and he gave me a book called Fortune Tellers, and it was the early stock market prognosticators, and from the turn of the century in New York. And part of it was initially it was all outlawed because fortune telling was outlawed, and so it's funny that they called them fortune tellers because you could call them fortune tellers today. So I think we need to look at the future and think about it. So I don't dismiss the idea of trying to think about what the future looks like, but I think it's more you have to be more humble and a little bit more broad based in your view of it. I like to tell folks is the ice thick or is the ice thin? I can't tell you necessarily whether you're going to fall in, but it's more of like what are the general conditions.
That's a great saying.
Yeah. So. But yes, and I think the other thing too is you got to recognize in the marketplace, there's always a buyer and a seller. So if unless you're issuing new stock, if I buy a stock from you, I now have the stock, and you now have my cash. Mm-hmm. We've just traded risky asset from risk-free asset. One of my little pet peeves is this whole idea of cash on the sidelines. There really is no cash on the sideline, right? I mean. The cash is something that's effectively put out there by the Federal Reserve, and until they retire it, someone has to hold it.
Is there an argument that can be made that cash is a, like you said, stocks are risk?
Yeah.
Is there an argument that can be made that the dollar is a risk because it's just fiat?
Yeah, of course. Yes. So there is risk there, and I suppose you can ask like. If you were a British investor in 1850, that would have been a risk for you that then came to fruition in World War I. So yeah, or Dutch investor before that or whatever. So yes, there's always sort of that risk. But I'm thinking about more in terms of like the thing with the dollar is that right now I can spend $1 and it's legal tender for goods and services. Yeah. So until that's not the case. I don't know that I worry about it so much.
Do you have some of your personal holdings in gold and silver?
Yeah, of course. So I'm a big believer in just diversification, and my sort of starting point. And again, this is a debatable thing. Other people might not agree, which is fine. But I do start from. To me, it's the most logical starting point is a cap weighted index, and cap weighted meaning that if you could own, proportionally all the assets in the world, that's the cap weighted index. Now, can you do that in practice? Of course not. But we're a lot closer to being able to do that than we were 50 years ago because a lot of assets have been securitized. And so you can buy a share in most of the large companies in the United States, most of the large companies in the rest of the world. You can buy a share in their debt. And so I like to start from that premise of start by owning the market, and including in currencies. I mean, I think, you can be sort of over concentrated in the U.S. dollar, but you can own foreign currencies as well. And think of it this way, if there are only two currencies in the world, let's say the dollar and the euro are the only two currencies. If I own them in proportion to which they were issued, I would effectively be insulated from currency movements, right? Because if one goes up, the other goes down. And so, I think you can make currency risk a relatively small part of the problem
Yeah.
of risk if you do it right.
Is there a way to mitigate the inflation effects on your savings? Obviously, you can't when spending,
Yeah,
but
yeah. So I think you know lots of people have thought about this, and there's a bunch of different views out there, but certainly you could get one of the things people talk about are commodities. Over the very long time, though, again, sort of against what Malthus thought. I mean, if you look at the 100-year price of any commodity, it's declined in dollar terms because we've become more efficient. Even gold to some degree because we've gotten better at recycling and mining and stuff like that. Yeah. But I mean, certainly energy and whatnot. But they are good short-term inflation hedges. The problem is they're quite volatile, right? So that's hard for people to hold. But again, in the long run, the real hedge is human innovation and owning the means of production. If you own the means of production, you're in a good spot. And so if you own sort of things that produce real tangible assets, you don't really care what currency you get paid in.
Definitely. I feel like owning that, it can be also like attributed to the whole investing in yourself because it's not, a loophole to maybe this is hot right now.
Yeah.
It's kind of self-driven things.
And I think too, the investing in yourself, like I said, I mean, life's more than just a good return or money or something like that. Yeah. I mean, there's also sort of the value of, like I said, if you invest in yourself and you say invest in your own business or something like that, you're potentially creating jobs for other people, and so I think that's a positive thing. But also, you're living life. You're gaining the experience of working hard and trying to solve a problem. That ultimately serves others.
I really like the dog and the wagging tail analogy.
Yeah, so I made that comment, right? That don't let the money be the tail of the dog and wag the dog. Think about sort of your answer to sort of the big questions of life. Wrestle with those first, and come up with your answers to those. This sort of existential questions of why am I here? Who do I want to be? Mm-hmm. Who do I want to serve? Answer those first, and then use money as a means to implement your vision or whatever, versus chasing money is a fool's game.
Yeah, you're going in circles like the dog.
Yeah, exactly. Yeah, it just I don't know. At least that's my view.
Speaking on diversified portfolios.
Yep.
What's the largest asset in your portfolio? Or like, what's his largest holding?
Yeah, sure. So I probably have a lot of safe assets and in my portfolio right now because I think in general the ice is thin for risky assets, and so those assets are tend to be cash and cash-like securities. I think liquidity is valuable in times when markets reprice, but I don't think that that's necessarily what should be the largest holdings in everyone's portfolio. I think in general, as a firm, we'd recommend equities as the largest holding in people's portfolios if your time frame is long enough.
Gotcha. So for like a college student with a long time frame, would you recommend going for like an index fund kind of route or?
Yeah, I certainly think starting off, unless you have a special interest and it's going to be your hobby or it's going to be your career or whatever, I think broad diversification, buying a Vanguard product or an iShares product, so you could buy, there's a ticker VT, that's the Vanguard Total Stock Market, the global stock market. I think that's a great place to start. you own a share of every single company in the world for 10 basis points, which is 0.1% cost.
Yeah.
That's a pretty good deal.
Mm-hmm.
And until you have decided and really thought about how you want to make your alpha, that's a good place to start. Now, as I mentioned, I would make sure that you were, and again, this is just personal opinion, but I would, make sure you pay off your high interest debt and all that kind of stuff first, and have a nice rainy day fund. I would have all those things in place before I, bought my first share of stock or even an index fund.
Definitely. Is there a kind of person you gain, like a famous person you gain investing insight from? Because that just made me think of like Dave Ramsey. He's always like, no debt, no debt. And then go. Is there someone that you gain inspiration from?
No, it's funny. People always say, "Oh, what books have you read?" Whatever. I mean, I've been doing it so long, I don't know there's any one that like that's just sort of like, oh, this is the pinnacle of investing. I did really like Against the Gods. Peter, I think it's Bernstein, read his Remarkable Story of Risk. That's a pretty accessible book. And of course, everyone's read Black Swan, but I think that's, Taleb wrote a nice book there. But no, I'm not really, I think, I actually kind of think reading philosophy and reading, great literature, stuff like that is actually a better use of your time than
it just expands your mind in different
ways. And you've got to somehow bring the sort of the way you see the world philosophically or existentially into marriage with the practical knowledge of what you're doing. So, mm-hmm. I mean, I think Ecclesiastes is probably my favorite book. If and I'd say I love, and I think there's lots of investing advice in there. And Ecclesiastes 3:11 says, time and chance happen to them all, and the race is not to the swift, and the race is not to the strong. Right? Time and chance happens to them all, and that's the market. Is time and chance. It's those are the two. In the business division. So you do your NPV analysis. It's like you've got two things in the equation. The number of years and the discount rate. That's time and chance. And I think, I think it's healthy to have, like I said in the talk I gave, some sort of theory of the world is as important as the actual practical, nuts and bolts of what you got to do. Now, you get to work, you got to do the nuts and bolts, right? I mean, Definitely. So you got to have to do those daily grind kind of things, and those have value in and of themselves as well. But I think it's nice from a reading perspective. Say, what do you like to read? I'd say, a Russian novel or something.
Wow.
Yeah.
I think that's great too, because it kind of pulls you away from, what you do every day, which is mm-hmm. tracking the market and are used to.
Well, and ultimately the market is. So there's these sort of two forces, if you will, I don't, off the cuff, but like, one, you're trying to get the sort of fundamental business right in terms of the cash flows it's going to produce, the innovations it's going to have, its profitability, and you're trying to do all of the things they teach you here in business school to make the right determinations about what that path looks like. And companies are valued on that way. And I mean, there's the classic saying of like, in the long run, the market is a weighing machine. In the short term, it's a voting machine. And then that's the other force, is the voting machine is like speculation, and it's the exuberance, and it's, humans after all this time are still driven by greed and fear, and those things oscillate back and forth. And so, I think reading great literature or philosophy or whatever helps you think about that sphere, the nuts and bolts stuff. You get in your classes and your textbooks and stuff.
Because I feel like the larger sphere brings you back to the emotional side of humans. And
what drives people? Why do they make this decision? And why do people crowd, and why are there herds, and mm-hmm. Why people have anxiety, and and why are people greedy, and all those kind of things, and sort of seeing that and seeing patterns in that, I think is helpful.
There's a quote from Charles Munger I heard. It's the 3 L's will kill a man: liquor, leverage, and ladies.
Yeah.
You think that's got some, like, what do you think about leverage and you think it's
Yeah, I thought we were gonna go to ladies first. No, yeah, no, yeah. So I think so. One of the things we're trying to do with our company is we talk about being a 100-year firm, and the idea there. We've been around for 45 years now, and or thereabouts, and the idea there is to create something that's perpetual, that outlasts us, that's really for future generations, if you will. And I think also it aligns with what our clients want to do is this whole leave a legacy in terms of to have it be intergenerational, and that's a very difficult thing to do. And so I think it's sort of less than 1% of companies make it 100 years. And there's a guy from Royal Dutch Shell that did sort of a research on this, and so this is really from him. But he looked at the characteristics of firms that last 100 years, and one of them was a conservative capital structure. And I think the challenge with leverage is that if you're levered, you become a forced seller in bad circumstances, and that's what creates discontinuity and bankruptcy and stuff like that. And so if you think that, like, if you're sort of humble enough to sort of say, I don't know the future all the time, and you're also say, I'm going to be around for 100 years, there's going to be a period of time where I'm levered, where I have borrowed too far, and that's going to kind of surprise me and come back to haunt me. Now, if you think that you can foresee the future, then lever up all you want, but in reality, we can't foresee the future, and it comes like a thief in the night, right? And so leverage is like that, in that you don't know when the ice breaks through, and if you're levered, it's like you're carrying some weights around with you, and it's just the likelihood that you can sink. So if you're really building something for longevity, I think leverage is a very dangerous thing. So I would agree with that quote.
Gotcha.
A little bit more constructive on ladies and liquor, but.
And then last thing before we got to wrap it up for today, what's your take on algorithmic investing? And I feel like that's kind of a newer.
Yeah, this is sort of like going back to that sort of alpha consideration of, like, again, the gold rush being the first one there, is that and part of this is having worked at that hedge fund. I mean, the resources we had were amazing, and to think that someone sort of sitting in their kitchen in the morning reading the Wall Street Journal can match the depth of work that was being done, and beat that. That's a really high bar. I'm not saying it can't be done, but it's sort of like, I don't know if you've ever seen the Braves have that guy, whatever, I forget what his name is, but the guy who races around the outfield. Yeah. And they get this sort of local guy out of the stands, and they race him, and he gives the other guy like a 20-yard head start, and he always catches them, right? So the idea that you can sort of beat someone who is very well equipped and trained and whatever in a race is you got to think twice. So I think algorithmic trading is interesting. I mean, it's really been around since Renaissance. I mean, since the 90s, but now the math and the mathematicians and the computer scientists that go into doing that, it's pretty serious stuff. Yeah. And it's certainly over my head. And so, it's like, I think you have to be careful about entering an arena unless you think you're as equipped as the guy you're going up against. So don't go in if you're JV and the other guy's varsity, kind of thing. And so I think it's great. Ultimately, a well-functioning market does help the end consumer, right? So if you think about, like, if you have a monopolistic market, if you walk in and the only guy in town that sells apples is the only guy on the street that you can buy apples from, he has the ability to sort of like mark that up in a way that if there's 30 apple salesmen, don't. So I think in a way, yes, algorithmic trading probably cuts some pennies off of the value that you get as a regular retail trader. But I think in the end,
it's the evolution.
Yeah, and it forces the market to be even more and more competitive.
But do you think if algorithmic trading was, as it gained more traction and got larger, it would take away the individual's perspective and just have people's money going into the most dominant picks more?
Um, I don't know. Yeah, I mean, and there's this whole concept, thought about like the index funds and are they bad in the sense that like, everybody is kind of sitting in the same boat and free riding off of active management. So I view algorithmic trading as an active, I'm taking that question as if they were active managers. If you're talking more from like sort of the index side, I do think that there's a risk there, and once everybody sort of gets in on the free ride, maybe there is more space to be active. And so, I think that's a fair argument. I'm not sure if I have a view on it one way or the other, but I do think have we reached that point? What's that tipping point? I don't know. But there are people out there still spending a lot of money on active management. I know that, though.
Definitely.
Yeah.
Definitely.
So it's not gone by any stretch of the imagination.
Well, thank you so much for coming on and bestowing some financial wisdom.
Sure.
And just wisdom in general upon me and the podcast viewers.
Yeah, well, thanks for inviting me, Ethan.
Yes, sir.
Happy to be here.
I would like to personally thank everyone who tuned into this episode of the SHC Division of Business podcast. Our aim is to give young professionals insight into their desired field or potential job of choice. If you gain anything from this, or have any compassion whatsoever, please share with someone you see fit.